Hey everybody, this is Kevin Durant from NEOL Solutions, back again with our 2022 summer video series. In this week's video, we'll discuss non-retirement investment accounts and the role that they play in a financial plan. Before we get started, please remember that nothing discussed here is a direct recommendation, and if you have questions regarding your personal financial situation, such as how a non-retirement investment account might make sense in your financial plan, please feel free to give me a call at 847-585-9800 or send me an email at kevin@neows.com and I'd be happy to speak with you further. If you've been following our video series this summer, you'll know that so far we've discussed the difference in tax treatment for deferral options into retirement accounts, and that there are limits as to what you can save into specific retirement accounts each year. Of course, that doesn't mean that we are limited as to how much we can save each year on an aggregate basis, or even that every dollar we save has to be set aside strictly for retirement. And so today we'll discuss the use of non-retirement accounts for that additional savings. Sometimes also referred to as non-qualified accounts, individual accounts, or brokerage accounts, non-retirement accounts are typically any taxable investment account in which dividends, interest, and capital gains are reported in the year that they are realized. From a tax standpoint, each dollar contributed to a non-retirement investment account by an investor becomes the cost basis or principal against which future capital gains or losses is measured. When these gains are realized, they can either be at short-term or long-term capital gains rates. Short-term capital gains are realized on investments held shorter than 1 year and are subject to ordinary income tax rates, which can be as high as 37% for those in the top tax bracket. Long-term capital gains rates, on the other hand, are realized on investments held longer than 1 year and are subject to long-term capital gains rates, which are either 15 or 20%. If an investor is subject to net capital losses in a given year, they can first use them to offset capital gains. If there are no capital gains to offset, they can use that to offset as much as $3,000 worth of ordinary income. Anything above that $3,000 can then be carried forward to future years. Although non-retirement investment accounts have slightly softer tax benefits than the retirement accounts we discussed last time, they aren't subject to the same 10% early distribution penalty if accessed prior to age 59 and a half. For this reason, they are very accessible and oftentimes a better option for money that might be accessed prior to retirement. Many clients use non-retirement investment accounts for things like a future college tuition bill, perhaps a vacation home, or if they've simply already saved the IRS maximum into their retirement accounts. Now, if you have questions regarding non-retirement investment accounts or anything not covered in this video, please feel free to reach me using the contact information below and I'd be happy to speak with you further. Please also feel free to share this video or comment below some planning topics that you'd like to know more about, and I appreciate you all watching.